Hi, Peter Rose from Longwood Currency Trading. I want to do a short video today on the topic of reward versus risk. This is one of the things that's talked about so much in videos and books and everything else. I have a little bit different view of it, but that's probably because I'm a speculator, a short-term trader, as opposed to long-term. You have to look at the risk differently when you're doing something over a long period of time as opposed to short period of time. My original career was real estate investment. Well, I was a computer engineer for 33 years, but I was a real estate investor for 40 years. That's a long-term trade, and the risks that you take are balanced against the time frame that you have, the asset to work with. And so when you're speculating, particularly in the currency markets where the volatility is not only there, but also because of the leverage that exacerbates that volatility, you have to be hyper aware of what you're considering to be a valid reward for the risk that you're going to take. And you also have to be very aware of the amount of risk that you want to take. I'm going to start out with talk about risk itself, even though that's not the first thing we consider when looking at a trade. You always consider the reward first, because if you don't have a reward, there's no point in worrying about what the risk is going to be because you don't take the trade. And I'll get into that a little bit later. But I think we have to take a look at this thing about risk. How much risk do you want to take? In the classical sense of risk and reward, you can look at the risk that you're going to take as a percentage of your bank. You can look at it as a fixed dollar amount. You can look at it as a fixed pip value. So, you kind of have to look at that sort of thing. When you're looking at risk in terms of evaluating it on a chart and looking at the structure that the chart is presenting itself as to where there's, for example, a congestion of price action. Let's say you're going to go short, and so you're up here somewhere and you're looking down here and you see some price congestion, and so that's probably about as far down as that price is going to go. If you go short, you're going to get bought out at that point, and the price will turn around and go back up. That's just basic trading stuff. So you look at the structure for risk. So a long-term trader, you would say, oh, I'm not going to take a fixed dollar or a fixed pip value for risk because the structure may not offer that to me. I'm looking at a position where the structure is 30 pips away, 200 pips away, doesn't make any difference. But let's say it's 30 pips away from a short-term standpoint. Let's say. Then would you say, well, I'm going to set my stop 10 pips? Well, the structure isn't offering that to you. Do you know whether you're wrong at 10 pips or not? Obviously, if the price has gone up above that structure 30 pips and you're looking at a retracement, or maybe that structure is in the past and you're looking at some other part of it, you're trying to evaluate what the structure is offering you. It's offering you 30 pips. So if you take 5 or 10 pips, if you're a short-term trader, the normal fluctuation of the price comes down and it goes back up may take you out prematurely. As a long-term trader, you would give yourself that 30 pip distance, because your reward that you're looking at excuse me, is 60 pips or 40 pips or something like that. Your reward should always be a little bit bigger than what your risk is, so that if you're a 50-50 trader, you're at least going to make up that small percentage difference. A lot of the analysis that I do, I use 53%. But that's neither here nor there. The point of the thing is that for the longer term trader, you can't say, well, I'm going to take 10 pips across the board out, because the structure is saying, well, it could go 30 pips against you if you were going to do a long trade, and you're looking at that short side. Well, how far down could that price go? Well, it could go down 30 pips. So if I'm looking at doing a long trade, excuse me, then you'd say, well, the structure is offering me 30 pips. So what does that mean? Well, if it goes to 30 pips, it simply is bumping into that structural support, if you want to call it that. There are economic reasons for that structure to be occurring, and if you just think that it's just jiggly lines on the chart and you're respecting that because the prices touched there before and reacted, that's just silly. You can't even think about that. There's economic factors involved in currency trading that cause congestion of price, and so you have to look at it that way. So what that's saying is that there's a lot of support 30 pips below you. So if you were looking at a 60 pip increase, taking a 30 pip risk would not be out of line. You'd still be 2 to 1 on your reward, so you'd be fine in that case. If you were looking at a 60 pip a risk and you were taking a 60 pip reward, you'd still be within a 1-to-1 reward to risk basis, so that you could look at that and say, well, I'm good. I could go long because I'm 1-to-1 on my risk. However, 60 pips is 60 pips. Do you want to be a 50-50 trader or 53-47 trader on a 1-to-1 risk to reward? Do you want to even get hit with a 60 pip loss? And I assume that if you're trading for 60 pips, you're trading full lot positions, not mini lots. So even if you're trading a 1 lot, you got 10 grand involved, you're getting 10 pips, or $10 a pip. So 60, that's a $600 hit. And even if you're trading with a $100,000 account, a $600 hit that's still a lot of money. You know, that's, some people don't make that in a week. So you have to look at this risk thing, and you have to be flexible in not only your view of what the price structure is offering you for your risk and your reward, but we're going to talk about that later, but offering, setting a basis of where your risk is. So you look at this thing at a 30 pip risk, and you say, well, I can't just take that 30 pip structural point. Price would have to pound down through that probably 10 pips in order to say, yeah, we're not going to respect this congestion of price. 10 pips is, is quite a bit. If it falls 30 pips and then it falls another 10, it's gone 40 pips. And you got to sit back at that point and say, I was wrong. The fact that it goes 30 pips and it bumps into that structure, and again, these structures tend to be 5 to 10 pips wide on either side. So you pad them 5 pips per side as buffer, so that if it comes down 25 pips or it goes 35 pips, you don't want to get out of your trade, because that might just be, it's going to come down there, it's going to recollect itself and go back up. And how many times have we been in trades where we get taken out because of a limit stop order, and the thing just turns around and goes in our favor? So you'd want that risk to be about 40 pips. Well, still with your target at 60, you're still okay. If you look at the structural component from a short-term trader's standpoint, however, you're not looking at a profit target of 60 pips. You're not looking at taking a risk of 30 pips. That's for sure. If you want to be in and out, you want to know whether you're right or wrong. If you're scalping, you're on the 5-minute or below chart. I'll scalp on the 5-second chart, because 3 pips $1,000. That's $3 a thousand. That's a pretty good return, 3 pips. You do that 10 times a day, it's 30 pips. Okay, so you know, um, you have to manage the view of the structure and the view of price action depending on whether you're a long-term or you're a short-term trader. I have a hard time with long-term. I'm impatient. I don't want to wait around. I don't think I learn anything. If I'm trading on a daily chart, for example, I'll have maybe 40 opportunities a year to make a decision. I can't learn anything doing that. Um, I'll be down on the 5-minute chart. I get a chance 12 times an hour to make a decision as to whether I want to take a trade or I want to get out of the trade. I know right away. Boom, boom, it's done. I know. And then I can wait for the next setup and I can get back in. As a short-term speculator, it's not unreasonable to approach a 70% win rate because you're taking these small little increments when you're wrong, and you're wrong. You go, the thing is not going my way. In the short term, it's not going my way. If it goes 5 pips or 8 pips against you, it's gone the wrong way. So you get out. So you lose 8 pips 3 times, and you make 10 pips 7 times. 8 pips 10. Do it the same way. You lose 8, you make 8. So you make 80, and you lose 24, 25. It's that sort of cramped situation. But when you're speculating, because you have a lot of what they call noise at the short-term charts, and it's not noise. It's from a mathematician standpoint, price action is what's called fractal. It goes along the lines of the mathematics of chaos theory. You look at a leaf and the outline of that leaf, if you zero in on it really close, you get that same kind of an outline. That's a fractal decomposition of something larger. So price action is the same way. If you looked at a 1-hour chart, if you looked at a daily chart and compared that to a 5-minute chart, and you didn't have any time frame or price bars on the thing, you wouldn't be able to tell the difference between the 1 hour and the 5-minute chart. You just wouldn't. So when you're down on the 5-minute chart, though, 3 pip moves, 5 pip moves, those are big moves because you go, then you come back up, you get down, back up, and you get this constant appearance of chatter. And so, you just have to change the way that you think about how you're going to execute your trades, how much risk you want to take. Do you want, on a short-term time frame, a 5 or a 1-minute chart, or God forbid, a 5-second chart, do you want to be setting stop limits that are structurally foundation? Yeah, well, you don't. As a matter of fact, you probably don't want to set stops at all when you're doing short-term trading, because you want the ability to have your finger on the button to get out of that trade and then get back in, boom, 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 back and forth. As soon as you go and start to set a limit order, you have a thought process that's involved. You have to think about what you're going to do, and that takes time. And you've got 12 decisions per 5-minute time frame chart per hour to make decisions. What are you going to do? You're going to cloud the decision process by setting limit orders? I don't think so. You've either got the setup and you're going to take the trade because of price momentum, which is a whole other discussion, or you don't. And so you have to look at risk differently. I feel in that case that the risk that you look at has to be a set pip amount. Not a dollar amount. It has to be a set pip amount. Because when you change the dollar amount, let's say you're in a position and you're running, let's say you staged in a couple of mini lots or a couple of full lots, it doesn't make any difference. You don't want that risk based on the dollar amount. Well, I'm going to risk $40 on this trade, or you wouldn't do that on a short-term trade. I'm going to risk $10 on this trade. Well, now you got 2 lots, and so you get too short or too congested of a thought process on that pricing. So the fixed pip amount makes more sense. I'm going to risk 10 and I'm going to shoot for 10 or 13 or 15. I risk 8 to try to look at 20. I risk 8 and I'm looking at 20 or 25 pips as a potential reward. Once I go to 5 pips, I'm 5 pips ahead. Then I start watching it really, really, really closely. If it continues to go in my favor, I lock the 5 pips in, stop. If it goes against me, I get 5 pips. That's, that's $5 out of 1,000. That's a 0.5%. I'm happy with that because I can always get back in. I'm going to get back in, so I'll take that half a percent. But I'll let it, so then I'll let the thing ride. Am I looking to get the full 20 pips? Let's say it's offering me 20 pips. And there's reasons, there's mathematical reasons why I have an 8 and 20. It's immaterial to that. Let's just say that my reward has to be at least 20. I'm not really looking to get what the structural reward of the position is. I'm looking to get 13 pips. So I'm locking the 5 and I'm looking for 13. I lock at 10 and look for 20. And then as soon as price starts to chatter or look like it's losing its momentum, another discussion or another video, then I just exit. I just get out of the trade. I don't put a stops and limits and all that crap on there because I just want to make the decision. I want to get out. A limit order, an order sitting there on my chart, is an impediment to my reactive ability, my mental reactive ability. Oh, I set a 20 pip target and I'm going to go for it. And I'm 3 pips away, so I'm going to wait for it to go. I don't know how many times I used to do that. I had 2 or 3 pips left to go on the target. The thing turns around and goes totally against me. And I end up on a loser because then I'm caught in this, well, it'll go back. It'll go back. Well, I just got away from putting the limit orders on the charts at all because then it doesn't have anywhere to go back to. It's going the wrong way. Boom, I'm out. Okay, so from a structural standpoint, you can have something that obviously, you can have this rising thing and come down here. And so here you come, and there you are. So from a structural standpoint, you've got this 20 pip profit target. And structurally down here, if you were a long-term trader, this might be 40, according to this diagram. So from a long-term trading standpoint, would I take that trade? Well, no, I wouldn't, because my reward isn't great enough to assume this risk. However, if I was a long-term trader, I don't mind inverting my risk and reward. I don't mind taking 2, 3, 4 times the risk to shoot for the reward, because I don't plan on ever having it go to 4 times my reward against me. If he turns around and goes 8, 10, 15 pips against me, boom, I'm out. The structure doesn't mean anything. If you look down on a 1-minute chart and the price is starting to go against you, well, what do you think that's eventually going to show up on the 5-minute chart, right? And it's eventually going to manifest itself on the 15-minute chart. And by the time you finally see it on the 1-hour chart, it's gone to 15 pips, or the 30 pips or 40 pips or whatever it is. So I'll just look at it on the short-term chart because that's the dog. Anything you see that's going to happen is going to happen first, and you're going to see it first on the 1-minute chart. And when that 1-minute chart, when those moving averages start to arc over or up, whatever direction you're trading in, when that price changes direction on the 1-minute chart such that the moving averages start to change, it's not going to be long before that's manifest on the 5-minute and on up. So there's no point in holding a position until it hits that theoretical risk point that you have. And if you're a long-term trader and you're doing that kind of shit, you're no wonder 90% of the traders fail. You know, the statistics from 43 million accounts from a major brokerage outfit reveal that 90% of the traders lose 90% of their money in 90 days or less. That happened to me. After 4 years of trading in a simulated account and reading hundreds of books and watching videos and all that kind of stuff, and I'm a pretty smart guy. I got a bachelor's in physics. I did real estate investment for 40 years. I got all this stuff. It took me 90 days to go through a $40,000 account. And then I lost more until I finally woke up and was like, well, what the heck is going on here? All this shit that people are telling you, it doesn't work. It's not true. The reason people are successful is they either know what they're doing or they're really, really lucky in the beginning and they make some money. And there isn't one of them, once they've made their money, that they're going to tell you the kind of stuff that I'm talking about here, because all of a sudden they lock it down and they become very conservative in their trading, and they go on this risk-reward crap and all these rules and all this other kind of stuff, and that's not how to win, that's how not to lose. And that's not how you trade, particularly not in speculation. That's not how I made my money in real estate, by worrying about my risk. I quantified my risk by looking at the building to start with. Is this thing going to fall down and whatever? What's the worst damage that could happen? I got insurance to cover all that kind of stuff, and I got some money in the bank that will replace the furnace if that happens to blow up. So I'm going to go in with it. I might be going in with a $20,000 margin or deposit for the purchase, and I'm looking at $10,000 for a new furnace. Okay, I get that. That's a 50% loss in my money, but I'm not going to be worried about that because I'm going to hold that for 5 years or 10 years or longer, a lot longer. In this kind of stuff, you really have to look at that risk component much differently than you do if you're long-term trading. And my position is, even if I was long-term trading, and there's sometimes some of these short-term trading things, I pull myself back away from the chart and I look at the 4-hour chart and I go, holy crap! I'm looking at 50 a profit target 50 pips away. You get all this gibberish going on, this chatter, but the 4-hour is showing it could go 50 pips. So I may be playing in there for 5 and 8 and 10 pips or whatever, but my big thing that I'm going for the day rests not 50 pips away, but I'll kind of cut that early and say 40 pips away. So I'm taking I'm not willing to take a greater risk, but I have a higher reward. So if you looked at really what I was doing, you might see the risk appear to be 6-to-1 on my reward, which is astronomical. But in reality, the fact that I'm trading short term has nothing to do with the fact that in my head, I'm saying this thing is going, in my case, I'm mostly a scalper short term on the short side, is 50 pips away. And I'm just grabbing 5 pips, 6, 8 pips at a time, chattering on the way down. When I see it start to turn against me, I'm done. I have a cup of coffee and I walk away from the screen. And I can make 1% a day on my risk. On my risk, my money risk, not on the risk that I'm taking on the chart. So in looking at risk, you have to first of all figure out whether you're a long-term trader or you're a short-term trader. If you're a long-term trader, don't listen to anything I have to say, because our brains are going to be wired up totally differently. A speculator is totally different than a long-term trader. And I'm amazed that I could be a long-term trader in real estate, but be far more comfortable. And I never did any flipping real estate or anything like that. I held buildings for 20 years, 30 years. I'm not a Warren Buffett, but that's what Warren Buffett says. He said, you don't want to own the company, don't buy the stock for the long term. So in evaluating this risk that you've got, you can look at these particular kinds of structural situations to say, well, all of this is offering me is 20 pips. And structurally, it could get as bad as 40. So that the tendency of this thing would be, look at this deep dive that this took here. And somewhere back there, you could probably see that same kind of scenario manifest itself. Well, if you've got this 40 pips down here, and only 20 up here, what's the likelihood, even as a scalper, that you'd want to go in and take this? You'd have to look, because look, here you see a little bit of congestion. And that congestion might be, let's make that 8. That congestion might be 8 pips away. So I'm trying to go to 8 pips, but I could very easily get a jerk back at 8. So I'm almost guaranteed to have to get out at 8. So why take the trade at all? Okay, so the first thing you look at is the reward side of it. I got 20 pips. That's good. I know the price is on its way up because I've got a 200 period moving average that says, you can't see that, but let's say that the price is moving up, whatever average you want to use. But there's all this danger that's down here. So yeah, the 20 pips, that's a reward. That's a reward worth shooting for when I'm looking to take an 8 pip risk and a 13 pip gain that I'm looking for to go on that 20 pips. So that's all worth it. But then you turn around and now you look at the risk side and you go, whoa, wait a minute. I've got a potential catastrophic 40 pip thing here that could be just a regular retraction to this, or an immediate 8 pip risk that could turn into 40. I just, next. I'm going to walk away from the table. Okay, so hopefully that's some discussion of reward versus risk that you might not have heard before. And again, you have to balance this with my personality, which is just a scalper. I'm going to go in, bang, 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 bang. I want to know right away whether I'm right. I want to know right away whether I'm wrong. If I'm wrong, I'm out. If I'm right, I'm going to ride that. I'm going to watch it. When it starts to stall, I don't care whether it even comes close to my profit target. Boom, I'm out. I can't tell you how many trades that I've been in where I've had that 8/20 probability thing, and the price will go up to and it'll be showing me 5, 8, 10 pip, and then it'll start to stagger and it'll come back down and it'll be break even, and then it'll go back up and it'll start to chatter there. I've only got 1 pip or 2 pips of profit. Boom, I'm out, because it didn't do what I wanted it to do. Again, I'm a scalper. I'm a short-term chart. If that price can't get to 20 pips in a consistent manner through that 5-minute period of time, I don't want to be in that trade. I don't want to carry that through the night. I just did that last night. Yesterday, had a trade. Went in with one, and it kind of farted around and bounced around. And there's plenty of potential for the thing to go down, and because I was short, and it just kind of, by the end of the day, I'm Eastern time, so after 12 o'clock, things start to slow down because the London session is shutting down because I trade pound dollar. And so I said, well, I'll just leave it on. It's a small position. I'll just leave it on. I woke up at 3 o'clock in the morning, came down to check my price. This thing had gone, oh my gosh, what was it? It was 40 pips against me. 40 pips! What the heck is with this? So I got in there and I managed the trade. It started to turn around. I added another position, another mini to it, because this is just a mini trade, and then I added a third a mini lot to it, and ended up with an overall 4% on risk to the trade for the day. And I closed it out, went and had lunch, and here I am doing a video. So again, my name is Peter Rose, Longwood Currency Trading. I'm not selling you anything, but if you do have questions or whatever, I do teach. I mean, I have a course that I teach. So if you want have any questions, or you just want to chat with me about trading, because I do approach it a little differently than a lot of folks do, then please get a hold of me, and we'll see if we can help you out. Thanks a lot for your time. Have a good day. Have a good trading day.